inflation is going to be well in excess of that. That's what the gold market is saying loud and clear, except nobody is paying attention, at least, in the mainstream, if you understand basic economics and finance, which of course nobody does if you're in the mainstream financial media. And most of the mainstream investors don't really understand what's going on. That's why they're not buying gold and silver. That's why gold and silver, even though they're rising steadily, they're not like soaring, right? Because there is no panic to buy. It's a very orderly, methodical rise that's happening day after day after day with minimal corrections. Getting back to this BRICS summit. So it's being held in Russia, right? Which is supposedly, right? Oh, we've got sanctions against Russia. The whole world is supposed to be, staying away from Russia, blackballing Russia. They're the bad guy. Putin's the bad guy, right? Leave them alone. Yet you have all these leaders from other countries, from China, from India, South Africa, Brazil, Egypt, United Arab Emirates, Iran. All these leaders are now in Putin's, backyard. They've come to Putin, right? So they're obviously not boycotting him. They're all there. What is the primary goal these nations have? It's to distance themselves from the United States dollar. That is the main agenda. They want to trade with one another without using dollars. So when China buys something from India, they don't want to pay for it with U.S. dollars. They don't want to use the U.S. dollar in these transactions. And they don't want to hold U.S. dollars as a reserve for their currency. So they want to come up with another system that basically eliminates the need for dollars. This is a big, big deal because now more than ever before, we need China, India, Russia, all these countries to buy dollars, to buy our bonds, because we have bigger deficits than we've ever had. We have to sell more bonds every day, every week, every month than we've ever sold before. And we need buyers. But the buyers are saying, we don't want to buy. We're trying to figure out how to run our lives without your dollars, right? Without your treasury. So we're moving away. They're going to create their own system. I don't know how they're working. I have a pretty good feeling that gold is going to be a part of whatever they do. If they come up with a new basket or a new trade currency that they could use to settle all their deals, it may include gold and some other basket of their currencies, right? Their own currencies. The dollar won't be a part of it. The euro won't be a part of it, right? They're going to have their own trading block. And if you think about these countries, first of all, the population that you're talking about, I mean, when you get India and China together, I mean, that's a huge population. Those are the two largest countries by far in the world. But then, you throw these other ones in there and think about the resources. It's not just the energy that you have in Russia, in the United Arab Emirates, in Iran, but the minerals that you have in China, in South Africa, in Brazil. So these are resource intensified economy. And so this is a huge potential threat to the U.S. dollar and its place in the world. And we're ignoring that. And also part of the impetus to move away from the dollar are the sanctions against Russia. And it's not an accident that the BRICS summit is being held in Russia. I mean, they could have held it in any one of these countries, but they held it in Russia. That is basically a thumb in the eye of the United States because they're saying, hey, we don't care about your sanctions. You know what you can do with your sanctions? We're going to Russia. And by the way, the Russian economy is doing fine. The ruble is doing fine with all these sanctions. We didn't impose the economic chaos that we thought when the sanctions were first put on into Russia. But what we did is we galvanized all these other countries that don't want to be the next Russia when it comes to sanctions. So if they move to gold, which is why they're buying all this gold, we can't sanction their gold. If they own gold and store it within their own borders, we can't do anything about that. Yeah, if they hold U.S. treasuries, sure, we got them by the balls. That's why they don't want U.S. treasuries. But the problem is, who's going to buy them? Because we have to sell so many of them.
In the recent BRICS summit held in Russia, an undeniable shift was in the air as leaders from China, India, South Africa, Brazil, Egypt, the UAE, and even Iran gathered in Putin's backyard. Despite Western sanctions and pressure to isolate Russia, these nations' leaders demonstrated their commitment to de-dollarizing and developing a new economic framework independent of the US dollar. As Peter Schiff outlines, this wasn't just a symbolic gathering, but a significant move towards creating a system that distances itself from the global reliance on the US dollar. For decades, the US dollar has been the world's reserve currency, anchoring global trade. Countries trading with one another, like China and India, often needed US dollars to complete transactions. But now, as Schiff discusses, these nations aim to conduct trade without the dollar and without holding US Treasury bonds as reserves. The implications of this shift are substantial. The US currently faces its largest deficits in history, selling more bonds daily than ever before to keep its economy afloat. However, these potential bond buyers are working towards a future where they don't need US dollars or treasuries at all. Schiff believes that a new currency structure might emerge, potentially backed by gold, a tangible asset that these countries have been amassing steadily in recent years. If BRICS nations were to develop a gold-backed trade currency, it would be a historic shift in how global trade is conducted. Instead of relying on the dollar, countries within BRICS could use a basket of their own currencies, perhaps blended with gold, to settle trades, reducing their exposure to the dollar's fluctuations. With major economies like China and India behind this movement, the sheer population and resources within BRICS form a formidable bloc. China and India alone account for over a third of the world's population, and when other BRICS members are factored in, this group represents a significant chunk of the global economy. Russia, the UAE, and Iran hold abundant energy resources, while Brazil, South Africa, and China are rich in minerals and essential raw materials. Together, these countries' economies are resource-intensive and could function well without the US dollar as their intermediary. The summit's location, Russia, also serves as a symbolic gesture. The decision to hold the meeting in a sanctioned nation emphasizes their resistance to Western economic dominance. For these nations, it isn't just about Russia. It's about preventing a future where any one country could be sanctioned to the point of economic collapse. They're building systems to safeguard their economic sovereignty, and a gold-backed trade system would ensure they're not reliant on a single nation's currency. This shift isn't just theoretical. There's a clear trend among BRICS nations. Central banks have been increasing their gold reserves significantly. Countries are bringing their gold reserves home from Western vaults, and this isn't a simple preference. It's a hedge against sanctions and a proactive step toward financial independence. If gold becomes part of their trade system, the US loses one of its most potent economic tools, the ability to restrict access to dollars. When countries hold their wealth in gold, they're immune to currency devaluation caused by inflation or fiscal policies from foreign governments. According to Schiff, this BRICS-led movement away from the dollar couldn't come at a worse time for the US. As the BRICS nations make strides in alternative trade systems, the Federal Reserve faces mounting pressure to continue funding the national debt through quantitative easing. Schiff has long argued that the Fed would eventually need to resort to QE because of the inflationary impact of ongoing rate cuts. Lowering interest rates may provide temporary relief, but it's a double-edged sword that fuels inflation and undermines bond prices. In Schiff's view, the Fed's hand is forced. It either must return to bond buying to keep yields manageable or risk a bond market collapse as rates climb unchecked. This growing interest rate dilemma reveals the disconnect between the Fed's actions and the market's reality. Schiff explains that the Fed's efforts to ease the economy with rate cuts won't be enough, as these cuts alone are inherently inflationary. Lower interest rates increase spending and borrowing, which fuels inflation. This inflation, in turn, is highly bearish for long-term bonds. As inflation expectations rise, bond prices fall because investors demand higher yields to compensate for the loss of purchasing power. Essentially, Schiff argues, the Fed's attempts to fix the economy are actually stoking the flames of inflation, which undermines the very financial instruments, treasuries, it's trying to preserve.
So we still have a weak economy. That's not why rates are rising. Rates are rising for the same reason the gold price is rising. It's because the Fed's rate cuts are a mistake. The inflation genie is not back in the bottle. We're going to have rising inflation. We're going to have skyrocketing fiscal deficits. So bigger budget deficits. We're going to have more supply of treasuries hitting the market, which, as I've said, are going to be monetized. I said the reason that the Fed is going to go back to quantitative easing, and I've said this since before they cut rates, When I predicted that the rate cuts would result in rising bond yields, I also said that eventually the Fed would end up going back to QE to try to get those bond yields to go down, because I knew that the rate cuts alone wouldn't be enough because they were inflationary and they were bearish for bonds. So if the Fed really wants bonds to go down, it's going to have to buy the bonds itself. But of course, first it has to stop selling bonds, because that's what it's doing now. It's selling bonds. And a lot of other people are selling long-term bonds. You'd have to have your head examined to want to buy a long-term U.S. Treasury. Even at 4.2%, inflation is going to be well in excess of that. That's what the gold market is saying loud and clear, except nobody is paying attention, at least, in the mainstream, because inflation is going to be much higher. And that's why the gold price is rising the way it is. And that's why bonds are falling, because inflation is bearish for bonds and bullish for gold. And so they're doing exactly what you would expect that they would do if you understood the predicament that the U.S. economy is in, and if you understand basic economics and finance, which of course nobody does if you're in the mainstream financial media, and most of the mainstream investors don't really understand what's going on. That's why they're not buying gold and silver. That's why gold and silver, even though they're rising steadily, they're not like soaring, right? Because there is no panic to buy. It's a very orderly, methodical rise that's happening day after day after day with minimal corrections. And you're not seeing any, blowout move in the mining stocks. Yes, finally, we have new 52-week highs, multi-year highs in the GDX and the GDXJ. The next key resistance is to really take out the 2020 COVID high. Even though gold itself and now silver, both metals are higher than they were in early 2020. Neither of the gold stock indexes, or there's more than two, but none of the gold stock indexes have taken out their highs yet from early 2020. That's coming up. That may happen this week. And then I think it's off to the races. The idea that bonds are rising because the economy is strong, no. And in fact, I heard more people again say that, well, the strong economy means more inflation, and so that's also pushing up bonds. No, a strong economy would normally mean lower inflation, because a strong economy would produce more, which would keep a lid on prices. It's weak economies that result in more inflation because they result in more stimulus. They result in more money printing. Government revenues go down, their expenditures go up, they have bigger deficits, they print more money. So weak economies are historically far more inflationary than strong economies. That's what's going on. It's not about a strong economy. It's about strong inflation and a huge supply of bonds for which there are few buyers. And I'm going to get to more of that after this break. We're going to talk about the BRICS summit, which is another reason I think that the dollar is going to come under a lot of pressure and why bonds are already under pressure. So
gold's recent performance underscores this scenario. As Schiff highlights, gold prices have been steadily climbing, even hitting new highs throughout the week. This trend isn't a fluke. The gold market is responding to the deteriorating value of the US dollar and the Fed's inability to curb inflation. Despite rising gold prices, the broader investing public remains largely unaware of the asset's protective benefits, thanks to a mainstream financial media narrative that downplays gold's role. This ignorance could lead to a slow yet methodical increase in gold prices as savvy investors quietly accumulate more metal. At the same time, U.S. Treasury bonds have been steadily losing their luster. Inflation has become a clear and present threat to bonds, which tend to underperform during periods of high inflation. Rising inflation is historically bearish for bonds and bullish for precious metals like gold, which hold intrinsic value. Schiff underscores that inflation's impact on bonds will only worsen as the Fed's policies drive inflation higher. Schiff further expands on the domino effect that could occur if BRICS countries successfully move away from the dollar. The economic strategy pursued by the BRICS nations not only challenges the hegemony of the US dollar, but also threatens the dollar's role as the world's reserve currency. A significant point Schiff emphasizes is that the BRICS alliance could mark the beginning of the end for the dollar-dominated financial system, especially if this new framework incorporates gold as a reserve asset. For decades, the US has enjoyed the exorbitant privilege of being able to print the world's reserve currency. This unique position allows it to run massive deficits while maintaining international demand for its debt. However, Schiff points out that BRICS nations' deliberate actions to reduce their dollar holdings signal a pivot in this global dynamic. Instead of holding U.S. Treasury bonds as reserves, these countries are building their gold reserves, a hard asset immune to the Fed's monetary policies. The potential ramifications of such a move are staggering. If BRICS countries establish a gold-backed currency for trade settlement, it could be the beginning of a parallel financial system outside the dollar. Such a system would attract other nations tired of depending on the dollar, effectively creating an economic great escape from U.S. financial dominance. Not only would this dilute the demand for dollars, but it would also depress the demand for U.S. treasuries, which is currently essential for funding America's ballooning debt. Given this scenario, Schiff envisions the Fed's return to QE as not just probable, but inevitable. With inflationary pressures growing, Schiff argues, the Fed's rate cuts have failed to rein in inflation and will likely force it to return to bond buying. Schiff sees this as a recipe for even higher inflation, as the Fed's primary solution to rising bond yields and declining treasury prices will only make the underlying inflation problem worse. As he describes it, this is a vicious cycle in which the Fed is trapped. Reduce interest rates, stoke inflation, lose investor confidence in bonds, and return to QE to stabilize the bond market. This cycle could ultimately lead to a currency crisis where inflation runs so rampant that the dollar itself loses credibility. Schiff notes that mainstream economists and financial media downplay the risks associated with unchecked inflation, often blaming external factors like geopolitical tensions or supply chain disruptions. However, Schiff emphasizes that the root cause of inflation lies in the Fed's excessive money printing and manipulation of interest rates. As for the broader investing public, Schiff argues that many people are still oblivious to the long-term risks of inflation. The majority continue to hold cash or bonds, unaware that their purchasing power is eroding. He believes this ignorance is precisely why gold and silver prices have not soared yet. While prices are steadily climbing, they haven't reached levels indicative of a panic buy. But Schiff warns that this could change rapidly if and when the reality of inflation sinks in for the average investor. At that point, demand for precious metals could skyrocket as people seek safe havens outside the traditional financial system. While gold has gained considerable attention, Schiff points out that silver remains undervalued in comparison. The gold-silver ratio currently shows that silver is priced at historic lows relative to gold, presenting a unique opportunity for investors who want to hedge against inflation at a lower entry cost. Silver's industrial demand, especially in technology and renewable energy sectors, adds another layer of support for its value. As the world moves toward green energy solutions, silver's role in solar panels and electronics positions it well for long-term growth. Schiff also delves into the BRICS nations' stance on sanctions, noting that many countries view the U.S.'s approach as an overreach. By weaponizing the dollar through sanctions, the U.S. inadvertently accelerated the desire for a de-dollarized global economy. Russia, despite facing heavy sanctions, has maintained economic stability by pivoting to a more self-reliant and gold-backed system. The Russian ruble, supported by the country's gold reserves, has managed to retain its value, showcasing a model of resilience in the face of Western economic isolation. Furthermore, Schiff speculates that China and other BRICS members are closely watching Russia's success and may adopt similar strategies. China, for instance, has been quietly accumulating gold and reducing its exposure to the dollar. In the event that a gold-backed trade currency becomes a reality, countries would have a reliable and universally accepted asset that isn't subject to the whims of any one government or central bank. This level of autonomy is especially attractive to nations weary of potential sanctions. In terms of practical investment advice, Schiff encourages individuals to diversify into precious metals sooner rather than later. He stresses that the window to buy at favorable prices is closing, as the broader market has yet to fully appreciate the implications of a de-dollarized world. While inflation and rising debt levels may not be front-page news, they are fundamental issues that will shape the economic landscape in the coming years. As Schiff puts it, the BRICS alliance is laying the groundwork for a multipolar world where the dollar is no longer king. By anchoring their economic system to assets like gold and commodities, They are effectively building an alternative financial ecosystem. And if this system gains traction, the demand for the dollar will plummet, forcing the Fed to continue QE indefinitely to support the bond market. In conclusion, Schiff's analysis paints a sobering picture of the U.S. economy's future. With the BRICS nations actively moving away from the dollar and the Fed stuck in a cycle of inflationary policies, he foresees an economic environment where gold and silver will be among the few safe havens. As the BRICS countries gather momentum, the dollar's status as the world's reserve currency faces unprecedented challenges. For those paying attention, the message is clear. Prepare for a financial shift by investing in tangible assets like gold and silver.